Hi everybody, this is Scott Miller. I want to take some time to discuss ATR as it applies to the ATM Advanced Trade Manager, why it's important. So first, we need to define what is ATR. So if we take a look at some candles here, ATR is like a moving average of the range over which the last N candles runs. So if we're doing, say, a 4-candle moving average, this is our current time here, from high to low, that candle has moved around 7 pips. This one has moved around 4.3. This one has moved around 8.8. And this one has moved around 4.9. So if we add those numbers up and we divide by the number of candles, we get the average range of each of those 4 candles. You may have heard of the term average daily range, ADR. Average daily range is simply the average of the last N daily candles. So if we do a 10-period daily candles in Forex, that gives us 2 weeks worth of data. So the average size of the daily movement over the day or over those 2 weeks that's what we yield as our average daily range. Now, the traditional ATR indicator, the only one that's available in MT4 by default, is a simple moving average of those numbers. And a moving average is just like a moving window of however many candles. So if we're going to do a 4-candle window, I can pick up a rectangle here and draw here, include 4 candles. And this is sort of our window. So if I copy this here, we can go to the previous 4 and the previous 4 and the previous 4 and the previous 4, just sort of moving backwards in time. And so those moving averages would be just for the last 4 candles from whatever that is, and those numbers are going to be moving around. So I have 3 different ATR measurements applied here, and what we have is the traditional simple moving average. The average true range is the blue line here. And that's showing us what those averages are. So if we average up those points, we can see here that that is about 5.9 pips. Or, no, 59 pips. We're in the daily. Let's move down to a smaller time frame. And now we see that our average range is about 4 pips. If we do hourly, our average daily range is around 10 pips. So this is how much the candle moves in one time period, whatever it is, on average. And this is over the last 10 is how this is being used right now. And what I want you to notice is that it adjusts to the time frame, automatically adjusts to the time frame. It'll adjust to the currency pair. If we go to a big mover like the pound New Zealand, now our average true range is about 45 pips, whereas if we go to the euro dollar, our average true range is 12 pips. On the same time frame, different pairs. If we go to an index like the NASDAQ, our average true range is, let's see if I can get to the right one there, that is in this case, it'd be 64,000 points. So remember, it's going to be in terms of what the right-hand numbers are over here. So this is our average true range is actually $71.89 is what it's moving on average. So the average true range is self-adjusting. And what this gives us is a standard for moving between different currency pairs using the same rules because it all self-adjusts. If we go down to a low time frame and we move back in time, let me shrink this up a little bit, you can see how the average true range is moving up and down. And we have low periods of time when there isn't much movement, so we get into the opening period here. In fact, if we go to a currency pair like so, we're getting into very low movement and our ATR drops way down. So this is down around, a couple of pips. And then it moves up during the US session where we're actually up here sitting around 4 pips. So quite a change in the 5-minute, it's 4 times more movement, and it is self-adjusting. So this gives us a standard by which we can gauge targets and stop losses and all kinds of other management inside of our trades. So if we take a look here, I'm actually showing a bunch of different averaging of our average true range. So we have an exponential and we have a linear weighted ATR. Let's look at what the differences between those are. This is Aussie yen 1 hour, and I'm just showing these as moving averages so you can get an idea of how they're moving. Our simple moving average is in blue, and our exponential moving average, our EMA, is in yellow, and our linear weighted moving average is in red. And these are all 3 of them set to 12 periods right now. And you can see how the linear weighted is moving tighter to the movement of price. And the exponential is sort of sitting in between. There are times when the exponential hugs the linear weighted close and is far away from the simple. So there are deviations, especially as things reverse and are pulling around. So in the ATR world, what we would see is when you have rapid shrinkage and rapid expansion, some are going to respond faster than others. So that's the reason for having these different ATR methods available to us. They're not functionally terribly different, but they are different. Here we have a case where our volatility has shrunken quite a bit after the Japanese Open, and everything kind of quiets down, and it takes the simple moving average, the simple ATR, a while to respond before it comes down to where the linear weighted and exponential went right away. So if we look over here at our ATM screen, and we have a look here, our ATR is being calculated as we move across here. So right now we're doing an ATR of 10, and our smoothing currently is exponential. We can choose linear weighted and we can choose simple. They're all available. And if we are choosing to use ATR, our stop loss and take profit are set in terms of ATR. So let's go double our stop loss to 4 ATR, and let's put on a visualize. And we're going to visualize a sell here just so we get an idea. So we're opening here. I'm pressing the escape key to hold this. And so we're seeing that our stop loss up at this point is 14.8 pips. And I would expect this to be around 29 pips going down. And it is. Now, spread is included here, which is going to skew those numbers just slightly. If we take the spread off, you can see things pop around a little bit. So it'll, right now, because we are in closed market conditions, the spread is wide. So we would be more accurate with the exclusion of spreads. So let's measure this again. This is around 12.7 pips, or let's call it 128 points. So I would expect to see 256 going down here, and that's pretty darn close. So this is our ATR at work. Now, if we go to an area where things are more quiet and we go over here, remember, we were 128 points. Let's see what this is. This is more like 100 points now. It's adjusted to the movement that's sitting inside of this. So if we're trading a downtrend and we see we're in a consolidation zone and we do a breakdown here and we decide we want to open up in here, now we see that we have a reasonable target that can be fulfilled given the movement that we have. So let's go to something that moves a lot. Let's try the pound New Zealand. Now here we have a large movement going up, so we'll visualize that bullish. We need to change to our same settings, so we're going to be at 4 ATR. We're going to use ATR. We are going to exclude spread, and we're visualizing bullish, and we are sitting with an exponential. So here we are. Now notice how things get much farther apart as things start to really move up. So in the beginning here, let's say we decide we want to get in at this point, or maybe even up here where we've broken up above those previous wicks. We freeze that. Our 2 ATR stop loss is here at 37 pips, or 371 points, and this is on the same time frame that we were previously. And moving up here, this is 747, or almost 750 points. So it is self-adjusting. Your same rules can work in both small moving currency pairs and large moving currency pairs, and it responds to time of day. We get to a currency pair that is going to be quiet around the Japanese Open. Let's try and find something that's a good example here. Some of these things are moving a lot. We've had some pretty hefty news, but here we've got a large movement followed by a small movement. So let's try putting it on here. 4, exclude spread, visualize bullish. Here we're getting appropriate targets. We're not getting large moves up, but it's relatively appropriate to the size of movement. If we visualize bearish and we come up here, notice that we have appropriate targets based on the amount of movement that's happening. So this is my discussion of ATR as it applies to the Advanced Trade Manager ATM. Thanks for listening, and we'll catch you in another video.